Hi, I'm Peter Rose, founder of Longwood Currency Trading. How to trade Forex in a choppy market. The other last video that I did talked about trading when you're uncertain or in an uncertain market. A choppy market is pretty uncertain as well. And yet you have to change the way that you think if you don't have good rules that manage in a generic form all types of price action. In other words, if you have rules for this and rules for that and rules for that, those aren't really rules. You're trying to build systems to deal with the different aspects of trading. For example, a trend system is a system, and it works until it doesn't work. Well, when do you know that it doesn't work? Well, after you've lost a lot of money because you've transitioned from all this thought process of following this trend and now you're into a range-bound price action, or maybe you've done a swing. And you don't figure that out until something drastic has happened. Particularly if you're up on the longer range time frames where you're dragging your stop behind you and a considerable distance, you make 20 or 30 pips on your long haul, and it retraces and you wait 20 or 30 pips and boom, you're lost. So you haven't been, even if you made 5 or 10 pips, you're not paid over the course of the 4 or 5 days for your 5 pips or 8 pips that you make, or 20 pips or whatever. You're not paid for the time and the risk that you took in the trade. A lot of folks don't like to trade choppy markets because their rules, they don't know how to build the rules in order to do that. And I've ran into this before in my trading, and I've got chopped up because I've listened to all the books and everybody talks about trending. You know, the trend is your friend and blah, 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 blah. And yeah, that's great if you're trading stocks or something like that. But currencies is very hard to do a trend that's manageably tradable over the long term. It's going to be very difficult for you to go on a 300 pip hunt over a month period of time because of the characteristics of the Forex market and order flow and all that other stuff. If you can do it, that's great. Maybe you're going to go out and you're looking for that 300 pips over 2 months, and the price comes back against you a little bit, and you get out and you make 200 pips. Okay. Did 200 pips pay you for the amount of time that you held that trade, even though it's 200 pips? And, well, the alternative to that is what I do, which is day trading. And because I'm looking for short hops, the probability that I can make 5 pips every day on average, 5 days a week, is far greater than you counting on 4 or 8 800 pip runs during the year. It's a matter of time efficiency. If I can get into the market, for example, today, it's choppy. It's all over the place. It's running in 40 pip squiggles between, I don't know, it's looking like 15 pip pullbacks or whatever. So you jump on one, and you try to get your 10 pips for the day, and it swings around, pulls back against you. You're 3 pips underwater, so you hold it, and now you're 10 pips underwater, so you get out. That's the problem that we all face when we're trying to do that choppy type stuff. The rules that I have say, well, they're based on the price action. They're not based on my trading the price action. They're based on order flow. And so when I'm looking at my general daily goal, it isn't 20 or 30 pips. I have a profit target that is misnamed as a profit target of 20 or 30 pips before I'll enter a trade, but I'm not looking for that 20 pips. I may be looking for, maybe my capability as a trader is 12 or 15 pips. So I'm trying to strive for 5 to 8 pips locked. And then if the price is going to continue on, I'll get back in. I'll lose 3 or 4 or 5 pips in that process of getting back in, but I've made 8. So if I get back in 5 pips later and it comes back 5 pips against me, I'm still 3 pips up. 3 pips is 0.3%. You do that 3 times a week and you've got basically 1% a week, which is 44% a year. How you doing? I mean, the problem that we have is falling into the facade of these fantasies of position trading because it's safer. Or really, you have an 80 pip ATR on a daily bar, and that's safer for you. Where are you putting your initial stop? 10 pips? No. 20 pips? No. 40 pips? No. When the price could run 80 pips? No, I don't think so. You're going to have to be out an ATR or so. You might have to go an ATR and a half. So you're 40, 50 pip on a stop. You're trading a 1 lot. You're screwed. Or if you're going to be stupid and trade at 100 to 1 or 500 to 1 or something like that, you're screwed long before that is going to grab you. Now, there are methodologies that a good long-term position trader will take to mitigate those risks, and they have to be awfully good and have an awfully large supply of money underneath the money that's in the trade, so they're not going, oh my God, I just lost 100 pips but I've got 100 left, but you have to be very competent in order flow. In the shorter time frames, trading on a 5-minute with a 15-minute as your gauge for where you're going to set your stops and stuff like that, based on an overall trend at a 4-hour. I mean, what do you need to go out to the weekly chart to determine what you're going to trade over the next 2 hours? I don't think so. I don't think that's practical. And you might take a look at yesterday's daily boundary range and say, well, am I going to go above that or below that? Where am I? But I'm only going to try to grab 8 or 10 pips. So if I'm in a real chop and there's no clear direction that I'm going to go 20 or 30 pips in a regular trade, your rule has to say, oh, under these conditions, then you should do this. Well, what's this? Well, I took a couple of trades this morning. It went up and it went back down and it went down and it went back up and it went down a little bit, and I got out. It was a break even. It was a wash. So it still looked pretty good. So I got back in on the short side. It went balls to the wall up on me. My thing didn't hit. Well, it went so far on the upside that there had to be a retraction to that because it went beyond the ATR of the current price, not the 14-period ATR that's standard, but what was going on currently in that last 20 minutes. So I threw a short limit in there. It got hit. Boom, went down like 8 or so pips. I was going to get a little bit more. It started to stutter a little bit on me. I'm out 5 pips. Okay, so I'm up 5 pips. The thing turns and goes back up again, but not quite as far. So, well, let's get in it again. So I'm in there right now waiting for something to happen with that price. So I got to get back to it. But I wanted to make this video because I think you're missing a lot of opportunities if you're a position trader by not looking at these short hops. These small pip gains that you can make, even if they're really small, 0.3%, that's 3 pips that you can on any size bank. If it's a full lot, you're making $30. If it's on a 10 lot, you're making $300. It doesn't make any difference. It's 3 pips. If you only make 3 pips, as I said, 3 times a week, averaged, how tough is it to make 3 pips averaged out over every time you step up to the table? Well, it's not. So why can't you do that? Because you're trying to make 20 pips. Because you're trying to make 40 pips. Because you don't understand order flow. You're afraid of the chop. So rather than playing and trying to get a lock of 3 pips, maybe 2 or 3 times a day. So your winning value, average win value for the day might be an aggregate of 10 or 12 pips. You make a 1 5-pip run, you make a 3-pip, you lose 3 pips, you make 4, you make 3, and you're there. And you're trading 3 or 4 times, which is not scalping. You're trading 3 or 4 times in a couple hour period of time, then you go to work. And if you've only been able to trade a couple of times and make 3 pips, you're okay. Because if you could do that how tough is it to make 3 pips? How tough is it to take a trade that goes 8 pips in your favor, lock 3, it comes 5 back against you, and you've got the 3? Well, what's wrong with that? You have to manage your greed, not with fear, but manage the greed and say, how about if I just be greedy for 3 pips? How about if I just be greedy for 8 pips? There's a lot of traders, when you get really good, you can be greedy at the 10 pip level. That's what everybody talks about. Oh, you just make 10 pips a day, you're going to make a lot of money. No, if you make 3 pips a day, every day, on average, you can make a lot of money. Make 44% return on your bank. So when you are looking at trading in a choppy environment, don't be setting your goals for, I'm used to trading on these trends where I can grab 20 pips, or I can grab 10 pips, or 8 pips. Just look at it. You get down on the 1-minute chart, and you can see a normal ATR, for example, on a major pair on a 1-minute chart might be half a pip. On a 5-minute bar, it might be 5 pips. That's what my ATRs on the majors are doing right now. So you might have 5 pips on a 5-minute bar, 1 pip, say, or 3/4 of a pip on a 1-minute. So you could look at that and you look for the same kind of momentum value that you have, or maybe you're at a swing point, these jaggedy swing points, and you judging order flow, and you go boom, bid, and hit it and ask, and you're done. You got your 3 pips. Step back from the table. That was a success. You got your 5 pips. Step back from the table. Because if you get that 5 pips and you're in a chop, it could drop right back against you 8 pips. You're out 3. If you lose 3 pips a day, on average, you're going to lose 44% of your account. So you think of it the other way too. So let your fear not override your ability to trade in it in a choppy market, but don't let your greed stretch beyond the capability of what the market is able to give you. Your ability might be to get 12 pips on a normal day if you're following your trend system, or you're following your whatever it is that you're doing. But if your rules aren't fluid enough to take in trends and swings and chops and range-bound action, then you're limiting your ability to trade only during certain periods that your rules allow you to trade in. And then you don't find out that the trade's gone and you're in a range-bound until you've lost 2 or 3 times. So you take all the gains that you've made, maybe you've made 30, 40, 50 pips, and now you're going to lose 20 of them, trying to figure out what's wrong because now you're in a chop. You're not being paid for the time you're sitting at the desk. We don't want to sit at the desk more than 2 hours a day. We got to get to work. Or we're going to come home from work. We're at 7 o'clock at night. We have some food, take care of the kids, manage the thing, cut the grass, whatever you got to do. And when everybody else goes to bed, you're going to trade the Asian session, maybe if you're in the U.S. or something, or wherever you are in the world. Trade whatever's hot at the time. But your rules need to be structured to manage all types of price action. And the rules, therefore, have to be based not on you, but they're based on the market that you're trading. That's why the rules that I write, I don't have to change anything, because I'm looking for price action based on order flow and not RSIs and Bollinger Bands and all the rest of the stuff. Price action tells you what's happening, and you have to trade what's happening right then. Now, what happened 2 days ago? What's happening right now? What happened 2 days ago may be somebody was doing a big order of, the currency market's $6.7 trillion a day. So 3 days ago, some guy finished off dumping a $2 trillion order that he had, or $4 billion order, whatever. It was big. It caused a congestion area. Well, he's done. That's why the price came back down. So when you go back up and you look at what happened 4 days ago, and you have this line across these congestion zones, and you're saying, oh, well, I can't go any further than that because whatever. Or if I go beyond that level, I'm safe because it's gone past all that congestion. It has no meaning. Yes, the patterns do repeat. The congestions do repeat. But what happens in the middle of the congestion? And when do you know that the congestion is going to happen again? Just because it's happening right now doesn't mean that it's going to happen 10 minutes from now. Because when that guy's done with his order, that particular order flow that he's been putting into the market over the last 3 or 4 days, satisfying some $4 billion order or $1 trillion order or whatever the institution as a whole is doing for that particular client, well, they're done. The client's happy. The client's on the other side is happy. They're done. So who's going to support that now? All of a sudden, they're done. On the opening, they finish up all their stuff, and you're sitting there at the opening, yahoo, things are going up, everything is great, I've got this great order flow going on because of these past points, and it's going to continue on because you're looking at a longer term view where you should be looking at what's happening right now. And you can't see what's happening right now if you're looking at the daily candle, even a 15-minute candle. You see the bar and you see this little thing going like this. It's meaningless to you. Get down on a 1 minute or in the 5 second. That'll scare the crap out of you if you don't know what you're doing. It doesn't matter whether you're on a 5-second chart, a 50-minute chart, 60-minute chart, a 1 hour chart, or 4 hours or monthly. Price action is what's called fractal. Whatever you do down on a 5-minute chart, you're going to be able to do that same thing up on the daily chart. But if you don't learn how to do it on the 5-minute chart, you're not going to be able to just do it on the daily chart because somebody tells you some basic freaking rules. Because those rules on the daily chart are based on trend. That's the only way you can trade long-term position is trend. But the forex market doesn't trend the way other markets do. You have to understand that. So you have to be really, really, really good to trade up on the daily chart. And if you are really good, then it is safe and it does make sense and your risk management is much easier to deal with. But you have to have all that experience. I've been looking at the currency markets since 2007 and I would no more trade up on the daily chart than the man in the moon. But I use the daily chart for managing my expectations of what could happen during the day based on what happened maybe yesterday. That just makes sense. But what happens today could be a continuation of a trend motion, or it could be a range, continuation of a range, or it could be a transition between trend and range. It could be a chop. It could be anything. So I'm watching that on the 15-minute chart. I'm watching that on the 5-minute chart. I'm watching that on the 1-minute chart. And I'm creating in my mind the scenario of what is the market doing? What does that represent as order flow? And as soon as I can input into my rules an order flow data, not my decision data, I see this fucking line here and I'm going to, the RSI, that's not my rules. That's not what I teach in my training, in my course. I don't teach system rules. I teach rules that deal with the market and what's happening and our ability to interact with that efficiently. If your rules don't have that, or you don't have rules, or you don't understand the importance of it, watch more of my videos, because that's all I talk about. The life cycle of a currency position is what I teach in my course: entry analysis, position management, and exit methodology. Those are 3 problems that are abstracted out of the more larger problem of trading currencies. Each one of those problems has one rule that acts on it, and it doesn't matter whether it's a trend, it's chop, it's a swing, it's a chop, it doesn't matter. It deals with one rule. But that rule has between 2 and 4 conditions to it. And if all of those conditions, and the entry rule is more complex, obviously, and that has 4 conditions, if one of those conditions is false, there's no entry, there's no trade. One of the 4. All 4 conditions have to be satisfied. So that's what you do. Your static rule up above says, oh, well, if I get these conditions, the what, then how I'm going to execute that trade is I'm going to go in with 3 lots, or I'm going to go in with, a mini, or whatever bank size that you have. You might have a large account, so your overriding rules might say you're going to start and go in with 3 lots, and then you're going to build 5 on top of that, or you're going to go in with 5 and build 3, or whatever it is. But that's all far removed from the actual execution rule. So that in my fast track course, we're studying price action, not RSI and support and resistance and all that other stuff. Those are guides for us, just like our moving average doesn't tell you anything other than what happened in the past. A 20-period moving average on a daily chart tells you what happened 20 days ago. Who the fuck cares what happened 20 days ago? When you're trading on a 5-minute chart, although it gives you a sense for, geez, there were big orders that were made 20 days ago that form these congestion patterns up here. Maybe that guy's not done. How far back do those patterns go? Oh, this bank is dealing maybe with an auto parts manufacturer. They're not going to want their prices all over the place. They're going to want to only buy certain parts, billions of dollars of parts, at a certain price, and then they're not going to do it anymore. So they're building up their supply of parts at a certain price, and when the price gets too high, they stop. That's what the client is telling the institutional trader that's making that transaction for them. And so that pattern at that price may repeat itself right across where you're sitting. But what happens if you're in the middle of that? That could stop right then. In 5 minutes, it could be over. They could flush everything out at the opening and be done, and you're going long, and the price collapses. Or you could be in that downward period, and you're saying, oh, well, price then will go back up to that point. Well, maybe not. What if there's a big cluster of 15-minute candles over the last 2 or 3 days that prevent your price from going through that? And you don't see that because you're looking at that. That's what's going on at the daily. You see the problem? So if you're doing only trend trading, then that stuff may help you. But if you're dealing with the uncertainty of whether you're trending or you're in a chop, are you in a chop? How long is that chop going to last? Are you in a range bound? A chop is just a shorter period, a greater frequency, smaller amplitude. A chop is that. Whereas a range bound, you could be running, you could run 100 pips top to bottom and do that for a week or 2. Your rules need to be able to resolve the price action data that you're putting into them so that it's giving you a valid response. So if you got questions about this stuff, send me an email. I'd be happy to look at what you're doing, and if I can give you some simple guidance or something, I'm happy to do that. No charge or anything. we'll just continue to be friends and email each other back and forth. And I'd be happy to help you with simple, basic problems. If you're an experienced trader and you come back to me and say, gee, I'm doing this, but it seems that I don't understand why this isn't working. Well, that's I can look at that and I can maybe help you think your way through it. But if you come and say, oh, geez, I don't know, I'm not consistent in my trading and I can't seem to get a handle on what to do when these things are, I can't answer that in 25 words or less. I'll try to help and guide you and stuff. But my videos try to do that. They try to show you the focus that your mind should be on. But that's where my expertise in the Fast Track trading program comes. It's not a PDF file that I give you. There is a PDF file that we go through, but you get my personal consulting. I'm spending hours of my time working with you so that if you're 24 years old and you're looking at that Fast Track course, your questions about what that course is telling you to do are going to be different than the questions that a 34-year-old or a 54-year-old would ask. And if all you have is what's in that course book, it's not going to be effective for you. The courses that I've taken before have all been books and PDF files and online stuff. I can't ask a question. You're telling me to take a 50 pip risk for a 150 pip gain. That makes a whole lot of sense. But how do I know that I have a greater probability of getting the 150 pips than I do of getting that 50? How do you manage the math behind the winning trades and the losing trades? That's not taught. This is just a recipe. Here's your recipe. Do this. It's not like you're baking a fucking cake where you can follow the recipe and get that result. Trading is different. And if you're 24, the answer to your question is different than the answer I would give to a 54-year-old. That's education. I've been an educator for 55 years in the martial arts, teaching self-defense and karate. Important stuff. And as I say many times, this is just money. This is easy stuff to solve. There are only a few variables that you need to understand. Entry analysis, position management, and exit methodology, with entry analysis being the most important. And that's why the Fast Track course concentrates about 90% on the entry analysis. Because if you can get the entry right, the position management and the exit methodology is easy. There's only two conditions for exit methodology. It's simple. But it's not simple if you don't understand the process of trading or how the currency market order flow manifests itself through the price action that goes on, and that you need rules that are adaptive across all types of price action, whether that be trending, chop, swing, range, whatever it is. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.